Hello, and welcome back to Market Visionary. Today we're diving into Alibaba, a titan in the e-commerce and technology space that continues to defy expectations. If you've been keeping an eye on Chinese tech stocks or are curious about how one of the largest e-commerce giants is navigating global challenges, this analysis is for you. In this video, we'll explore Alibaba's recent earnings, its strategies to return value to shareholders, its evolving market position, and why the stock might be significantly undervalued. Let's jump in. Recent earnings performance. Alibaba recently reported its September quarter earnings, and the results were a mixed bag. The company beat earnings expectations with $2.08 in adjusted earnings per share, surpassing predictions by 3%. However, it missed revenue estimates, generating $33.7 billion, which represented a 5% year-over-year growth. While revenue growth has slowed, there's a lot more to the story. Hey everyone, welcome to Market Visionary. I'm just starting out, and I need your support. If you're enjoying this content, please hit thumbs up, and subscribe. As a thank you, I'm offering gifts to my early supporters. Just comment, subscribe, take a screenshot, and email it to the address in the description. You might get a special reward. Thanks for being here. Let's grow Market Visionary together. The domestic e-commerce segment, anchored by Taobao and Tmall Group, saw a slight 1% increase year-over-year. This underperformance reflects broader economic challenges in China's post-pandemic recovery. However, there's a silver lining. A quarter-over-quarter revenue acceleration of 1 percentage point signals improving conditions. Bright spots in Alibaba's business. While domestic commerce showed moderate growth, other segments shone brightly. 1. Cloud Intelligence Group. This segment grew by 7% year-over-year, reaching record revenues of $4.2 billion. The rise of AI-driven applications has significantly boosted demand for Alibaba's cloud services, positioning this division as a critical growth driver. 2. International Digital Commerce Group, AIDC. Alibaba's international e-commerce operations posted a staggering 29% growth year-over-year, driven by robust cross-border trade volumes and global market expansion. This is the fastest-growing segment in Alibaba's portfolio and underscores the company's efforts to diversify geographically. 3. Local Services Group. This unit, which includes delivery services, has also benefited from China's fiscal stimulus aimed at boosting consumer spending. China's fiscal stimulus, a potential catalyst, one of the most significant tailwinds for Alibaba, comes from the Chinese government's fiscal stimulus measures. These include reductions in mortgage rates, easing bank reserve requirements, and direct investments to revitalize the economy. As consumer sentiment improves, Alibaba's core domestic commerce business is likely to benefit substantially, particularly in segments like Taobao and Tmall. Additionally, forecasts from market analysts suggest China's e-commerce sales will grow to $4 trillion by 2027, implying an annual growth rate of 7.8%. Alibaba, as the market leader, stands to capture a significant portion of this growth. Capital returns and free cash flow strength. One of Alibaba's most compelling investment cases is its ability to generate and return free cash flow, FCF. In the September quarter, Alibaba generated $2 billion in FCF and repurchased $4.3 billion worth of shares. Over the first half of the fiscal year, the company repurchased $10.4 billion in stock, while generating $4.4 billion in FCF. Alibaba's board has approved a $25 billion stock buyback program, and there's speculation that a new program could be announced in 2025. These buybacks not only support the stock price, but also highlight Alibaba's commitment to returning value to shareholders. At a forward price-to-free cash flow, PFCF ratio of 10x, Alibaba offers a free cash flow yield of approximately 10%. This level of cash generation, combined with its ongoing buybacks, positions Alibaba as a capital return play, making it attractive even during periods of slower revenue growth. Valuation: an undervalued giant. Alibaba currently trades at a forward price-to-earnings (PE) ratio of 9.1x, significantly below its historical average of 10.5x. This implies an earnings yield of 11%, making the stock highly attractive compared to its global peers. Additionally, Alibaba's valuation metrics are competitive even within its sector. JD.com and PDD Holdings, its closest rivals, trade at forward PE ratios of 8.2x, but but Alibaba's diversified portfolio and market dominance set it apart. Alibaba's international operations, cloud business, and robust free cash flow generation give it a unique edge over its competitors. Based on its historical PE ratio of 13x and a consensus EPS forecast of $9.75 for FY 2025, Alibaba's fair value could be around $120 per share. This suggests significant upside from its current price of $89.35. Challenges and risks. While Alibaba's fundamentals are strong, it faces several challenges. 1. Growth slowdown in core commerce. The Taobao and Tmall group account for 42% of Alibaba's revenue. Any prolonged slowdown in this segment could weigh on overall performance. 2. Regulatory risks. The Chinese government's crackdown on tech monopolies in 2020 led to a sharp valuation reset for Alibaba and its peers. Although regulatory actions have softened, investor sentiment remains cautious. 3. Geopolitical tensions. As a global company, Alibaba is exposed to trade tensions and economic uncertainty between China and other major economies. 4. Buyback sustainability. While the current buyback program has been a boon for shareholders, a reduction in these efforts could dampen investor enthusiasm. Why Alibaba is a long-term buy. Despite these risks, Alibaba remains a compelling investment for several reasons. 1. Market leadership. As China's largest e-commerce platform, Alibaba is well-positioned to capitalize on the country's economic recovery and the continued growth of online retail. 2. Diversified portfolio. Beyond e-commerce, Alibaba's investments in cloud computing, AI, and international commerce ensure multiple growth levers. 3. Strong financials. Consistent free cash flow generation and aggressive buybacks make Alibaba a shareholder-friendly company with substantial financial flexibility. 4. Attractive valuation. Trading at a discount to historical and peer valuations, Alibaba offers significant upside potential. A giant poised for growth. Alibaba's recent earnings and valuation metrics underscore its resilience and potential. While short-term challenges persist, the company's leadership position in e-commerce, robust financial performance, and shareholder-focused initiatives make it a compelling long-term investment. At Market Visionary, we believe Alibaba represents an opportunity to invest in one of the world's most dynamic companies at a bargain price. What are your thoughts on Alibaba's future? Do you see it as a buy at current levels, or are you waiting for clearer signs of recovery? Let us know in the comments below. Don't forget to like, subscribe, and hit the notification bell for more in-depth analysis and investment insights. Thank you for watching, and we'll see you next time on Market Visionary.